So good afternoon, everyone, and thank you for attending today's Pacifica Partners client webinar entitled Navigating a Bear Market Amidst Inflation. This webinar is for clients of Pacifica Partners and will provide an overview of our assessment of the inflationary pressures gripping the global economy and the economic outlook going forward. We'll look at our strategy for the different scenarios that may emerge. Now, this webinar will feature an opportunity for clients to ask questions using the Q&A or question and answer feature at the bottom of your screen. We'll plan for about 40 minutes of presentation, followed by about 20 minutes or so of Q&A, as long as there is interest. The webinar will be recorded and a link will be provided about following week from now. Now, for any questions that come up that might be specific or personal to your own portfolio, please contact your own portfolio manager directly anytime after the webinar. And so without further ado, I'll hand control over to our Chief Investment Officer, AJ Sull. Thank you.
Great. Thanks, Naveen. I wanted to thank everybody for taking the time this afternoon with us. It's been a tough year, to put it mildly. Lots has gone on, and it seems like since 2020, the periods of respite have been few and far between. We wanted to reach out to everyone this afternoon to give you some perspective of what we are seeing and sort of what the path going forward may look like. Despite some of the headlines and the way 2022 has been, it's not all bad news, and we're going to try to give a balanced perspective of the way we see things shaping up. So basically, right now, the backdrop is pretty simple. I think we would all agree that it's been dominated by the fact that interest rates are on the rise, inflation making 40-year highs. I read somewhere that nearly half of Canada's population has never really experienced anything remotely resembling inflation. So for a lot of people, this is a new thing. And for people who sort of lived through the 70s, this is all sort of a unpleasant memory coming back. Right now, the inflation battle is centered around expectations. The reason central banks are acting so forcefully to bring down interest rates, to bring down inflation, raise interest rates, is expectations. And what they're worried about is that once expectations get embedded around inflation into people's mindset, into the mindset of labor and consumers, it's very detrimental to the economy. So they're going to do what they can to stamp out inflation, and so that people no longer sort of expect continued price rises. And so as a result, what's happening is equity markets around the world are repricing stocks for not only the fact that interest rates are higher and expected to continue higher, but also they're worried about, well, what if they raise interest rates too far and tip the economy into a recession? And a recession means lower corporate profits and therefore lower stock prices going forward. And then the aspect is the...
You have to reshare your PowerPoint.
I have to reshare my screen. I'm sorry. That's good. Sorry about that. Can you take a look on my end? Where am I?
One second here, just making sure that we're set up.
There we go. It is this one, screen share. All right, thanks. Sorry about that, everyone. I've made this Zoom mistake a countless number of times. You'd think I'd learn by now. So the inflation battle centered around expectations, and the future path of the economy is all about, if we're going through recession, are we going to have stagflation, which is recession with inflation that persists, or are we going to get by? And this is what we want to look at this afternoon. So an overview of the current conditions. So if we look back to 2020 coming out of the COVID recession, about a year passed where people were debating what kind of recovery are we going to have. And it turned out to be a pretty darn good recovery. You would call it a V bottom where we hit bottom and immediately bounced back. That being said, it looks to me what happened is that the recovery has now been changed such that people are now focused on what kind of slowdown are we going to have? Are we going to have a slowdown where it's going to be a long drawn out recession, a short and shallow recession, or are we going to have what's called a soft landing? And a soft landing is where basically interest rates rose, inflation gets stamped out, and the economy sort of resumes a nice gentle upward path again. The hope is for the soft landing, of course, but as some people have said, the runway for a soft landing is getting shorter and narrower. And so the longer inflation persists, the shorter the runway is and the greater the risk is that recession will eventually be upon the economy. Right now, central banks are basically saying, look, we're willing to risk a recession in order to basically, number one, get back their credibility, because a lot of people, investors in the financial markets have started to question central banks' commitment to inflation and to fight it. And the other aspect is that what happened was in 2020 and 2021, central bankers said, don't worry, inflation is going to be transitory. It's going to be here and then it's going to be gone again. However, it looks like they made a mistake, and they basically are admitting that mistake. Actually, in very explicit terms, they know they made a mistake. How did we get to this point where we've gone from 4 or 5% economic growth coming out of the recession after COVID to the point where we have inflation? Basically, it comes down to this: is that we had the recession. Governments and central banks around the world applied an enormous amount of stimulus. That stimulus stayed on too long. It's now overheated the economy. And now we're back to restrictive policy where they're trying to take away the effects of stimulus. And if we look at it, we've kind of come full circle to the point where we're focusing on, hey, are we back to recession again or not? Basically, the policy errors were, as I say, too much stimulus. There was a misreading of inflation, and they got behind the curve. Basically, central banks were slow to act. So those were the errors, but there were some factors that were beyond their control. When stimulus was applied and left in place, the worry was to avoid the economy slipping back into recession. Well, what they couldn't foresee, policymakers, was that China was going to have a zero COVID policy, where they sort of continued to shut down some of their key factories. That in turn impacted the global supply chain, where companies said, hey, we can't supply our customers who want a dishwasher or a stove or a fridge or whatever have you, because our parts supplier in China is shut down. And if we look at it, the other factor that was beyond central bank control was that workers simply refused to come back to work, partly due to health concerns or worries, partly because some of them said, you know, I can do better. I'll look for a better job. The job market's very good. And then the factor number 3 was geopolitical conflict, specifically pertaining to Russia and Ukraine. That's again beyond the central bankers' control. So the whole confluence of events happened in a very short amount of time. So we're looking at 3 possible paths, and this is where we're sort of trying to position client portfolios. Is the 3 possible paths are we going to have a recession in the back half of 2022? And one of the aspects there is that one of the things we're looking for and worried about is we want to see the home builders, the home building sector continue to strengthen. Right now, it clearly has taken a back step here due to higher mortgage rates. The business investment falling off, that businesses are starting to worry about should they be battening down the hatches or should they continue with business investment? And then the other hallmark of a recession would be that if we see a sharp decline in consumer spending, which we're seeing in part now, and if it's sharp enough, that'll tip us into recession this year. Or the other alternative is recession for next year, where we can sort of stave off recession for the balance of this year. And again, one way that may be able to do that is that job market is still pretty strong. Consumers are still pretty flush with savings. And we are starting to see some moderation and pressure on wages. So that may induce policymakers to sort of say, hey, maybe we are achieving our objective and we get by this year. Again, the most desirable outcome whenever central banks are raising interest rates is a soft landing. And the soft landing is really pertaining to interest rates continuing to rise, but we're getting closer to the end game as far as interest rates go. So if we look at inflation, what is it? In just defining it very simply, it's a trend of rising prices, and the effect of rising prices is that it erodes the purchasing power of money. It's measured. Usually we see three common indexes released whenever inflation is measured. It's the consumer price index, the CPI, which gets the most attention, producer price index, and the most important one that we don't hear enough about actually is the personal consumption expenditures index, or PCE. I put the PCE in bold here because that's the one the Federal Reserve focuses on. So when they're looking at inflation, it's that number that sort of determines what they're going to do as far as interest rate policy goes. And there's some good news on some of these measures, and we'll show you in a moment what some of those numbers are starting to look like. Inflation can be fueled by rising wages relative to what workers are producing. So we've had that, where due to worker shortages, people not deciding to come back to the labor force, companies had to raise wages. But if you look at the aggregate output of the economy and what was being produced, it's nowhere near what the wage bill has gone up by. So there's this mismatch, and that's causing inflation. Not enough supply of goods and services. So this goes down to the supply chain. If anyone's been looking for a new car, you go down to the car lot in the last couple of years, we have seen where new cars are really, really hard to come by. And then the third one is typically is just too much demand in an overheated economy, and we've had even some of that. So when we add the three kind of conditions for what fuels inflation, they were all present, and lo and behold, no wonder we've got inflation. So as I mentioned earlier, inflation expectations are a key focus. Central banks have noticed that households are starting to change their behavior. Workers, and including we're seeing increased uptick in strikes in Europe as well, especially where workers are now demanding higher wage increases. What happens is as wage increases get increased, it then perpetuates the inflationary cycle. And so some good news would be that if unfortunately, it's not a pleasant thing to say, but some increase in the unemployment rate would not be a bad thing for the overall economy. Again, that's something that markets would look favorably upon as long as the jobless rate doesn't get too far as a trend. What we're looking at is if the expectations can be reset, that would be helpful, but typically they come at a great cost to the economy, and that great cost typically is a recession. And as the Federal Reserve Bank of Cleveland President Loretta Mester said, she said, and she's a pretty good voice that the markets pay attention to. She said, recession risks are going up because we could have pivoted a little earlier than we did. And basically what she's saying is, we waited too long to raise interest rates. And so as a result, recession risks are going up. And here's the aspect is that if we go back to March of last year, the US Federal Reserve basically had said, don't worry about it. We're not going to raise rates until 2024 at the earliest. And the Bank of Canada said the same thing. They said, we're advising households, go out and borrow whatever you deem that you need to borrow, because don't worry, we're going to make sure rates are staying low. You fast forward to today and or this year, and basically the central banks have pulled the rug out from underneath consumers who had borrowed with the idea that, hey, don't worry, we've been told rates are going to stay low. They've gone the other way and said, no, we're going to not only raise rates, but we're not going to be nuanced about it, to use their own word. And so from that perspective, if you look at it, there's been an abrupt policy change. And I will say that my own thought as to what's happened in the last, certainly in the last 6 or 8 months, if you look at it, what happened is in the US, this head of the Federal Reserve, Jerome Powell, the gentleman on the left of the slide here, was up for nomination for a second term. And was he going to be confirmed for a second term? And all of last year, he kept saying, don't worry, inflation's transitory, it's not going to persist. I think it was within 3 days in the month of November of last year, within 3 days of being confirmed that he would get nominated for a second term, he changed his tune and said, oh, by the way, inflation's not transitory. Obviously we can't know for certain if that played a part in his language and signals to the market. But basically, as luck would have it, or timing would have it, 3 days after being nominated for the second term, he came out and said, oh, we got to change our interest rate policy. Historically, what has it taken to stamp out inflation? Well, this is a pretty neat chart we got from the Financial Times. And basically, it shows there's in light blue is the inflation rate measured by the Consumer Price Index. And in the past, what it has taken is for interest rates to be raised to about slightly higher than the rate of inflation. So if we were looking at it today, that would mean that the US Federal Reserve would have to raise interest rates to 8%. Now, that's not going to happen for a number of reasons, because in today's heavily indebted economy, there's just no way that they could pull that off. That being said, we also don't think that inflation is going to persist at these levels. So as much as there are a lot of really well-respected voices that say, look, in order to get inflation down, you're going to have to raise interest rates a lot higher than where they are now. That line of thinking precludes the potential for inflation to turn down lower on its own. And I know that sounds like hopeful thinking, but again, we'll show here that there may be some signals that that's in fact what is happening. If we look at the bond market, and what is the bond market saying about inflation and future policy? What these 6 lines here measure is at different points in time, what the federal funds interest rate looks like. So this is the interest rate that the Federal Reserve in the US sets, right? So in June of 2020, the bond market was saying, don't worry, interest rates are going to stay at 0 for the next 3 years. So if we went to June of 2020, for 36 months out, the bond market was saying, don't worry, interest rates are going to stay at 0. As time has gone on, the bond market has started to change its tune and sort of said, no, interest rates are in fact going to go higher. And that's what these lines are showing. But look at now, in June of 2022, the bond market is saying that, look, 36 months out from now, interest rates will have been cut substantially. So what the bond market is predicting is that the federal funds rate will get to close to 4%. But eventually they're pricing it in that rates will start to be cut. So again, just to clean up this chart here a bit, 1 year from now, 12 months from now, interest rates will be 4%. But that will mark the high point, and the bond market is saying they're going to start getting trimmed. Interest rates will start getting cut. So if we look at that, we're looking at maybe between 3 and 4 more interest rate increases potentially. Now, again, bond markets can change, and there's some reason to believe that we may not even have to get to 4%, hopefully. And here's one of the things that we're looking at. So this is the interest rate on 10-year US government bonds going back to into the 1970s. And for roughly the last 40 years, this interest rate has been coming down. It's been trending down. In the month of March, we briefly got above this 40-year trend line, just briefly, and it retreated. And interest rates started to retreat here. If by chance that this interest rate will come down below this trend line and start to stick down into the lower twos here, that should mean that the bond market is saying, hey, this fight against inflation has been won, and that things are going to come back to normal. And typically what happens is history sort of shows that this interest rate on 10-year government bonds peaks about 6 weeks before inflation does. So if this area here in the circle is a peak, then we may see in the next couple of months inflation has peaked and the fight has already been won by the Federal Reserve and other central banks. Again, so if we look at it here, we talked about the expectations, and this is probably what is fueling the Federal Reserve to be so aggressive. We looked at it here, is that this is the expectations for inflation amongst different household groups. So by income, the 25th percent of the top 25% of households by income, and then the rest, the balance, the other 75% of households here in light blue. You can see the bottom 75% of the income ranked households, they're sort of saying inflation's going to spike. And the top 25% are just sort of saying, no, we think the cost of living is going to be pretty low. But this action here in the expectations is what's prompting the Federal Reserve to not only raise interest rates aggressively, but also to use quite strong language where they're sort of saying, hey, if we get to a recession, so be it. It's not going to change your mindset. Truth be told, what they're trying to do is use language as opposed to policy to try to sort of cajole people's mindset away from inflationary thinking. And in Canada, it's very similar. If we look at the expectations for inflation 1 year out, consumers are expecting 7% inflation. Again, so it's very similar language to the US Federal Reserve. The Bank of Canada is saying that, look, once inflation expectations become entrenched, inflation becomes self-fulfilling, and that gets really tough to stamp out. And in fact, in the 1980s, the US had to raise interest rates to nearly 20% in order to quash inflation. So this is something that the central banks around the world, Canada and the US and Europe, belatedly, are trying to get in front of. So one of the aspects we looked at was that one factor fueling inflation was supply chains. But if we look at some of the data for Canada and the US, what we're seeing is that imports are very, very strong. So here it is in Canada. If supply chains were challenged and goods were not available, then how is it that Canada's imports have skyrocketed over the last year and a half? Or how is it that retailers such as Target and Walmart have been caught with too much inventory? It must be because the supply chain is not as broken as it once was. And so if that's the case, then that is positive in the fight against inflation. The other aspect here is that if we look at wages, wages are a big component of the inflation story. If we look at what's happened here, inflation rates in the US have skyrocketed far above what the wage growth level is. Again, against the fight against inflation, that's a positive. Why is that? Because it means that, well, unfortunately for households, their spending power is reduced. Their money doesn't go as far as it once did. So this will long-term be helpful for the economy. It's not that anybody should be against higher wages. Of course, that's a positive from so many different perspectives. But what we don't want is where wages and inflation are rising together. So if wages have been contained, inflation should be contained as well, ultimately. This was a chart that I came across just this morning, so we included it, and I thought it was really good. And here's why. It gives us some really good data here. What we're looking at is, and this is produced by the Federal Reserve Bank of San Francisco, they were looking at, well, what's driving inflation? There's the demand in blue, supply chain issues where goods are in short supply, and ambiguous, to be honest. I don't know what that means. I think that's pretty much everything else that's driving inflation. But the important thing is here, if we look at inflation, a large component of inflation, about 3% of the last inflation reading, was due to shortages of goods due to supply chain issues. Well, if we sort of assume that the supply chain is getting better, then a large component of inflation should start to mitigate relatively quickly, because prior to the pandemic, supply chain issues were barely contributing 0.5% to inflation. So if the supply chain is getting better, this green component to inflation should get eroded down relatively quickly, hopefully, and that'll help on the inflation front as well. And on the demand side, already consumers are retrenching. As you can see over the last 3 months, the demand pressures have started to come down. We just finished looking at the fact that wages are not keeping up with inflation. That should also help to bring down inflation as well, if we can continue along these trends. And here's the chart that we've been noticing for the better part of this year, and I'm not sure that it's getting the attention that it should. And so what this chart shows is, remember we looked at 3 components, 3 ways to measure inflation, the CPI being one of them, and the personal consumptions expenditure, PCE, being the other way to measure inflation. Well, look at what's happening here. Here's your CPI, your consumer price index. It came in at 6.5% in the US, excluding food and energy. The PCE index has come down to 4. What the Federal Reserve said, I think it was as of this morning, one of the Federal Reserve governors said, look, if we can get the core PCE down to 2.5 to 3%, we'll consider that a win and the inflation fight over. Well, a couple of more good inflation prints, and are we going to be there where I've sort of drawn in this line at the 3% zone? It very well could be. It's something to watch for and something to certainly hope for. I will say, you may have noticed that I've sort of said it excluding food and energy. And the reason for that is that central bankers, when they set policy, they will typically exclude food and energy. Unfortunately, households will rightfully say, hey, well, so if you're saying if I'm not spending money on food for my family or gasoline for my car, then inflation's okay. Unfortunately, it's a big component of our everyday expenses. That being said, it doesn't generally factor into policy setting, though. They sort of exclude food and energy as well. And we're going to talk about food and energy in a moment. So when we look at commodity prices, that's been a big factor in inflation. And a lot of people were pointing to the fact that commodity prices, food, energy, etc., were rising so quickly that, you know, there were fears that, are we going to have some kind of 1970s type of shock to the system? And there's actually some good news on the commodity front as well. What I think, again, I'm sort of mystified, if you will, that it doesn't get enough attention, is that when we looked at different commodity prices, whether they were agricultural commodities, wheat, corn, soybeans, natural, and then the energy side here as well, look at how much commodity prices have dropped from their peak in Q1. So some things peaked in February, some things peaked in March, and then some of these actually peaked in May. But there's been a big time drawdown in commodity prices, and that is helpful for inflation. Now, where we're sort of in between here a little bit is, okay, are these commodities dropping because some of the speculative and the fears that were embedded about future supply due to the war in Russia, between Russia and Ukraine, various other factors, has some of that fear premium come out? Or Is it that people are worried, the markets are worried about the economy and therefore industrial metals and copper and things like that are falling just due to a perception that future demand is going to be lower due to a recession? And honestly, we can't say. What I can say is that this is helpful for inflation, and yet nobody's talking about it because these are big, big drops. And here's what that, if I go back up here, so we said wheat was down about 37% from peak. And here's what that looks like. You've seen the price of wheat cut by over a third. And we think that probably it'll back down into this where it was in September. As magazines tend to do, The Economist had a great cover story about the coming food catastrophe due to the war in Ukraine. And, saying that, grain exports would be cut off, things like that. And certainly, from a logical perspective, it's something that seems very reasonable. But and it was certainly a concern of ours. We sort of said, boy, this inflation thing might get a lot worse in the initial days of the war. But when we looked at it, something very interesting, when it comes to wheat prices and the fear was, the Russians are going to cut off wheat exports from Ukraine. Russian wheat is going to get blacklisted from the global markets. And what's interesting is that the world produces about 800 million tons of wheat a year. But still, 200 million tons of wheat are traded between nations. Could we sort of mitigate the impact of the war? Yeah, we could. And I think that's what the markets have sort of figured out. They said it's not going to be that bad. And they've driven the price of wheat down. Again, this has not showed up at the grocery store just yet. But if this persists, we should start to see it reflected in inflation and what consumers pay in the grocery store as well. Oil, it's a different beast altogether. But again, something that's been catching our eye for the last number of months was that the war in Ukraine started February 24th. Well, oil spiked to about $132 a barrel. The war has gone on now for 5 months, right? Or coming up to 5 months. And the price of oil is considerably lower than it was. It's down about $30 a barrel from when it spiked on fears that supply would be cut off. Yet, why is that? And I suspect it's, again, some of that fear premium has come off, but also, again, it should start to show up in the inflation numbers going forward. Again, we noticed the magazine cover for The Economist about the coming food crisis, and almost on schedule, the price of wheat went into free fall. And it's been the same way with oil over the years. Right at the bottom, it's about how the oil market's finished, and at the top, it's, oil's going to keep going and get ready for $150 oil. Over here was the last one from The Economist, and they basically were saying, the oil era is over and we're going to go full scale to green power. Instead, we're seeing record coal usage in Europe and in China and I believe in parts of India. So one of the things is that in our work, when we look at sentiment, it sounds odd to say, but magazines are a reflection of popular sentiment. And so when we see magazine covers like this, it causes us to think about things in a different perspective. And I will say, when it comes to inflation, Business Week had a cover story a little less than 2 years ago, where they sort of said the cover story was, "Is inflation dead?" And here we are. When we look at oil prices, and one of the things we're trying to gauge is, certainly for client portfolios, how do we want to add, and then how much more do we want to add exposure to energy stocks? One of the things we uncovered is that going back to the 1950s, that one of the things is when we plot energy stocks versus healthcare stocks, so this is a ratio of energy stocks against the healthcare stocks in the US, the rising line means energy stocks are doing better. And if it's falling, it means energy stocks are doing worse than healthcare stocks. Well, when energy stocks top out against healthcare, it also coincides with big drops in the price of oil, which we've put on the top panel here. What's catching our eye is here, where the pink arrow is. The energy stocks have had an absolutely terrible 4 to 6 week period relative to the healthcare sector. If this trend was to break down again, we should see oil prices come down, all else being equal, using history as a guide. Again, that should help on the inflationary front. There's a few mitigating factors where I sort of have to look at that possibility with a bit of a skeptical eye, and I'll show you in a moment why I think it's perhaps wishful thinking to see oil come down very, very much from current prices. So basically what we're faced with right now, or certainly countries are faced with, is balancing the energy crisis today with the push towards being more green. We mentioned in I think our second to last newsletter, perhaps it was, where we looked at what's happening as far as the oil industry and the energy challenges in Europe. The war in Ukraine has made that challenge even more stark, where Russian gas has been cut off, so Europe is using more coal, things like that. And there's talk about, perhaps the only way forward on green energy is to build more nuclear capacity for power. But central to all of this is that, and why we think oil prices are not going to come down, even if there was a recession, is that there's just simply not enough supply of oil. There's not a lot of extra supply kicking around. And if we look at the refineries in the US, they're running right now at about 94% of capacity. Normally in the summertime, they take downtime to repair and do maintenance and things like that. So these refineries are running flat out and they can't afford to take the downtime. When you're running a factory with that kind of speed and at that level of momentum, things are bound to break down. So when one refinery breaks down, it has a significant impact right across the economy as far as gas prices go. So it's not that easy on the inflation front when it comes to energy. And then, quite frankly, a lot of nations have looked to OPEC, the Middle Eastern countries primarily, to try to say, hey, can you guys produce more to help out with and bring down the price of oil? They really don't have the capacity to raise production either. So the hope was that, if Russian oil is being sanctioned, can the OPEC countries produce more? And quite frankly, they can't. They don't have the capacity to do that. They never spent the money, much like in North America, to increase future production. So now the European nations are looking a little bit more at Canada, especially to do more. And Canada is sort of not really being committal to helping out on increasing energy supply. If we look at the components of oil demand, it really hasn't changed much. In particular, gasoline and blue, the demand is pretty darn consistent. Even in 2020, when we had the lockdowns, oil consumption for the year was not really affected that much as you would think, given how much of the world economy was on pretty much complete lockdown. So the idea that a recession will come along, reduce demand and create excess supply of oil, which would then bring down oil prices, doesn't seem to be very feasible at this point. I suspect, and I was listening to a webcast from an energy consultancy just a few days ago, and they sort of said if there was a significant recession this year or next year, they could see oil coming down to $90 a barrel, 80 at the worst. And so from a client perspective or a client portfolio perspective, we're looking at that and saying, hey, if oil is, in a worst case, if our price of oil is $80, aren't these oil companies still a great deal, even if there is a recession? And so this is something we're evaluating as far as investment opportunities go. If we look at it here, what the US has done to help slow down the pace of oil increases is they've sold about 102 million barrels from the Strategic Petroleum Reserve. And so when we're looking at that, that's helpful, but it's really a drop in the bucket because the global demand for oil is 100 million barrels a day. So at the margin, maybe it's helpful here and there, but really, and the other thing is at some point that oil that's been sold has to be bought back so the reserve can be refilled again. Here, as we say, even if oil got to $70, which is below that 80 threshold, we think the oil companies in North America will generate an enormous amount of cash. And what we're trying to figure out is where's the bottom in the oil stocks here. This year, in 2022, we have not bought very much in the way of oil stocks for new clients. We were heavier buyers in 2020 when the oil stocks were kind of out of favor. And somewhat into 2021, we bought some more exposure. This year, we've been sort of waiting for our chance. We think we have that chance now. It's just a matter of threading the needle where we think the bottom might be in. But so we are looking to increase our exposure to energy stocks sooner rather than later. But why have prices fallen? So I mentioned that the demand for oil is so strong and the supply is, just barely meeting that demand. Why would oil come down about $30 a barrel? And the simple reason is, or the most likely reason, that the financial demand for oil products by hedge funds, speculators, players like that, is about 28 to 30 times what the actual demand for oil consumption is. So if we say that the demand for oil is 100 million barrels a day, right now as it is, the demand from the financial markets for speculative and hedging purposes and things like that is 20 to 30 times that. So when a hedge fund is closing, and some hedge funds have closed this year because of a disastrous year, or they're meeting redemptions and things like that. So one of the first things they're going to sell is what they can get their hands on, and that's their oil exposure. So they're dumping their oil exposure, putting downward pressure on oil. It's not because of recession worries or all of a sudden the oil markets are flush with supply. It's really the financial actors are distorting the price of oil. I mentioned that we are looking at oil investments for client portfolios and to enhance our exposure where we can, and to buy other names that we haven't bought before. When we look at the oil stocks as a percentage of the US stock market, in the 1980s, they were over 25% of the market. Even in the oil run-up in 2007 and 8, they got up to 15% of the whole market. Right now, they're at 5%. Even though oil prices have gone from 20 to $100 a barrel, the oil stocks as a whole are all very small. I mean, this 5% is both equivalent to Apple. So to put it in perspective, if you had the money, you could buy all of Apple or you could buy all the oil companies, take your pick, but they're both equivalent in value right now. So we think given the enormous cash flow and profits that this sector is generating, this 5% figure should at least get back to the long-term average, and that means upside for oil stocks. Bonds, it's something that doesn't get talked about as much when it comes to investing in things as much as stocks do, but they are a critical component of the overall financial system. And what we think is that really bonds had gotten simply too expensive. Everybody wanted to own them over the last few years. We sort of took the opposite bet that, I think the last time we bought bonds in a significant manner would have been probably 2018 when the US was raising interest rates and bonds were on sale. We really sat it out for the better part of 3 or 4 years. And because we sort of said, boy, these are expensive and they're a recipe to lose money, and boy, were they ever. And let's take a look. In Canada, the bond index is here. We took over the last 5 years. This is the average annual return of the various components of Canadian bonds. So 5 years ago, June 30th of 2017, if you bought the short-term bond index, a person's return would have been 0.86% per year. That's before taxes and before inflation. If you bought long-term bonds in Canada, you would have lost about 1% per year for the last 5 years. Again, so we decided that, look, this was 3-4 years ago, whatever it was, that look, these bonds are going to not be profitable. We're better off holding cash and not losing money and making very little than we are on sort of committing money to losing capital. Conversely, today, we are starting to be quite interested in some of the deals available in the bond world. Here's on the US side, again, very similar story, slightly better than in Canada, but measured in US dollars. Again, the various components of the bond market have returned about 1% or less per year for the last 5 years. Bonds have not been a very big contributor to investor returns for quite a while. Again, how do we navigate that? Remember, we were told by central banks that interest rates would be pinned down and that they would even be willing to tolerate inflation. I had a conversation with a bond shop, a company that specializes in bonds, and they had various products last summer. And I sort of put the question to them. I basically said, look, you guys are saying, don't worry, central banks are going to pin down interest rates. And I said to them, what if the bond market decides, hey, central banks they've fallen asleep on the job. They're not doing what they're supposed to do, which is protect against inflation. And they said, don't worry about it. They got lots of tools to make sure the bonds don't get out of hand. Well, as time has told us, and we can see that they don't have the tools to keep bonds in hand, and quite frankly, now not the willingness to keep bonds from falling in price. So I think investors were sold a bill of goods, to be honest. And so our solution to that was just hold cash and wait. And now we've waited, and we think we can put cash to work in bonds for somewhat decent returns. Looking at the equity markets here, the aspect is that for a long time, people have said, hey, don't buy US stocks. The US stock market is too expensive. And again, we took a contrarian or counter view to that. We didn't think US stocks were expensive relative to the profits they were generating. And we still don't think they're expensive. And we're still not that interested in looking at Europe or emerging markets and other parts of the world. We're content for now to stay in North America, but we're always looking for, hey, when will that day come, or when is the right time to lower our exposure to North America and be looking at Europe or Asia or other parts of the world? And so from our perspective, when we look at the US stock market measured on a price to earnings basis, the market has been brought down to a pretty reasonable valuation. One thing we can see is since 2014, 2013, the market has bottomed out at about 16 times its profit level. Even during COVID, we didn't get too much below 16. And right now, we're not too far above that now. There's some, I won't get into the details. There's, I'm using trailing earnings here, meaning what was the profits over the last 12 months. Markets are forward looking. We want to know, if we had a crystal ball, what are the earnings going to look like in the next 12 months, right? So not trailing, but forward is what we really want to focus on. In our work, we use a blend of trailing and forward because we know the future is unpredictable. Despite how many analyst reports we get on a given day, we always take them with a slight grain of salt because forecasts are forecasts, and we don't want to put too much stock in what any one analyst has to say about any one company. Here's where some of the good news is. So we know, of course, that the 2022 has been very rough for markets. And what we found is some data. Just a few weeks ago, we were looking at some stuff, and we wanted to sort of look at it and say, when we've had a quarter where US stocks have fallen by 15% or more, what have the subsequent returns look like after that? So in June of this year, the quarter ending June, the US stock market was down about 16%. So we used a threshold of 15. And what we can see is that going back to the 1960s, the subsequent returns have been very strongly positive after such a quarter in red. So again, we won't take that on faith and say, oh no, hey, isn't that great? That must mean that the coast is clear. Let's take on lots of equity exposure and we're going to make lots of money for our clients. We're just sort of saying, look, based on history, we shouldn't be surprised, and let's look for conditions that may satisfy this outcome. So we want to be careful of that, but at the same time, recognize that bad news is often followed by good news. And this is typically also where investors have given up on stocks as well, which we're seeing signals of that as well. So markets tend to surprise what the consensus is. And so if somebody said to any one of us, hey, I just took a look at the future and the returns are going to be 10, 15, or 20% over the next couple of quarters, we would, unless we looked at this data, we'd say that person is trying to trick us into something, right? So again, this is some positive that we can take for now. And then we saw some data going back to 1926. We sort of said it's great. Since the 1960s, the previous slide has been very positive. Well, what about going back even further? And so what we took a look at is that how have US equity markets bounced back from 10% declines at any given point in time? And you can see here that, again, after a 10% decline, typically the average return has been 12.5%. Over the next 3 years, it's been 35% total, and 69% over the next 5 years, total return. When the markets have fallen 20%, very similarly, you find that the returns have been very good in the next 1, 3, and 5 year time periods. And very similarly, when the markets have fallen 30%, it's an anomaly. You would think, based on these two, that the 5-year cumulative return after a 30% decline should be even higher, but it's actually not, but still it is very, very positive. And something else that, again, along the same lines of thinking is we did see some data, I guess it was in the month of May or June, that the consumer sentiments numbers are at record lows since this data series came out in the early 70s. And so when we looked at this, we sort of said, look, the consumer sentiment index has hit 50, meaning consumers, when they look at, and who could blame them, they look at their cost of housing, their cost of food, the cost of gasoline, various other things, the cost of living in essence, how could they be in a positive mood? Well, what's interesting is that when consumer sentiment gets this low and turns, the subsequent stock market returns are very, very strong. In the 1970s, the US market returned 22% in the next year. In the 1980s, it returned 20%, and so on. So if this is going to happen again, and based on the previous two slides we looked at, should we not consider the possibility that stocks are going to return us a very strong level of return? And conversely, when we look at it, when consumer sentiment is very, very good, the future returns are nowhere near as good. And why? Because typically a consumer is going to be in a positive mood when things are perfect or close to perfect. Well, we know that once the economic cycle gets to perfect, that's typically when the market is starting to now look at the downside, right? One other chart, we hesitated on including this just because it's perhaps a little risky to try to communicate it in a clean manner, so I'm going to give it a shot here. What this indicator in blue measures is the percentage of stocks in the S&P 500 that are trading above their average price over the prior 50 days. So we take any stock, let's take Exxon, and you take their 50-day average of where their stock's been. And if the stock is trading above where it's been over the 50 days prior on average, then it's going to be a positive. And so if we look at it when the market was at its lows a few weeks ago, only 2% of the stocks in the US market were above their average of the 50 days prior. Well, that's pretty washed out, meaning everybody's selling stocks and there's just no trend except selling. Well, when we get to those levels of only 2%, and then you get to very quickly to a level where now 20% of the stocks are trading above their 50-day average, that's coincided with market bottoms. So when we hit these two thresholds, the market has had a significant rate of return after that. Again, we would never take any one indicator as a green light. We take it day by day, and we're trying to be as careful as we can. We're also trying to be as balanced as we can and not let the fear sort of freeze us from what we think is the proper action. So we're trying to be balanced. We're being cautious as we can, but when we look at past data, we try to use that as a guide to help us. And then just the last couple of notes on recession. I mean, that's the biggest question. So I will say that one of the things I think we noticed here was that when the war began between Ukraine and Russia, I mean, and we're the same. I mean, every day we were trying to get updates, what's going on? I mean, how is this affecting, you know, how is that war progressing? Things like that. We even had one of our research houses whose work we get mention how a person should position their portfolio for if a nuclear war breaks out. I mean, all kinds of stuff was going on back then. So the one of the things is that we noticed was very quickly after the war began, the market stopped paying attention to the war, and it was more about interest rates and inflation. And that's actually a positive, because it means the market, through its sort of collective wisdom, is saying, look, this war is terrible, but it's not going to be enough to upset the global economy. Let's go back to old-fashioned items that we should focus on, like inflation and interest rates and things like that. So that's very positive. But one of the things we try to look at now, and then so we've gone from focus on war to inflation and interest rates to now recession. That seems to be where the market's focus is. So we said, okay, fine. We can't rely on economic data because economic data is too slow to come out to confirm if there's a recession or things like that. So we went back to the stock market, which is a real-time indicator. And these rectangles here are the last two recessions. And what these rectangles are, if we look at the start and end date of the recession as measured by these rectangles, what we notice is going into a recession, the utilities, which are a defensive sector, the market says, hey, I don't like the outlook for the economy going forward, but I know people will always need to use electricity and they'll pay their power bill, and those are good companies to invest in when we're doubtful about the economy. And so what you'll see is that the utility sector starts to outperform the broader stock market going into a recession. Somewhere in the middle of the recession, they top out and they start to fall, and meaning the market says, hey, I've seen the recession. I have a sense when it's going to be over. I don't need those utilities. I should be loading up on semiconductors and railways and tool makers and things like that. And the utilities fall back out of favor. Same thing going into the last recession. The utilities powered up, especially in the last year when the financial crisis was underway. But even before the recession was over, they topped out as the market began to see the end of the recession. And economy's been pretty decent. During COVID, the utilities again perked up. They faded as the risks path. What we're noticing here is that the utilities are not showing any kind of momentum against the stock market. So is it that the stock market is saying, hey, look, we're looking out and we're not too worried about a recession just yet? Because if they were, this indicator, this ratio should be powering higher. So far, it's not, it's contained. We're watching it, and if it starts to perk up, well, then that's a signal to us that, hey, that risk of a recession is a real deal, and we need to pay attention and position ourselves differently. Last one here on this ratio, with these ratios, is we also look at consumer staples. These are the companies like Procter & Gamble, Pepsi, Colgate, basically the companies that produce some of the necessities of life. When the market's in trouble, these companies tend to do better than the companies in the industrial side of the market. These are companies like railways, Caterpillar, 3M, PPG is a paint maker, industrial paint maker, these kind of companies, right? So when the market is fearful, the consumer staples are going to do better. But notice, this ratio tops out just as soon as the market bottoms out. So when the stock market here in the top panel bottoms, so does this ratio top out. So again, we're not seeing any indicators here that this ratio is running away and the fear of a recession is there. In fact, if this ratio was to top out again here, that's another signal that the stock market should be okay going forward. Finally, when we look at recessions and what does the stock market do, we went back to the 1940s, and even back then in the 50s and 60s, You look at recessions, start and end date. That's again what these rectangles are showing us. Somewhere in the middle of that recession, the market bottoms out. So again, the markets are a lot better forecasters of the economy than the economic data, and hence why we look at all kinds of factors to help guide us and to warn us, if you will, about recessions and things like that as well. And it's very similar when we look in the 90s. Very similarly, I think the one exception was the early 2000s recession, and I think that was just due to the excess of the technology sector where they had to be sort of wrung out. But really, generally, the market does a pretty good job of helping us find where the bottom of the recession is and when the recovery is about to be underway. So our strategy, finally, is basically, as I mentioned, we are starting to add bond exposure. We think rates are a lot better than they've been certainly over the last 4 years. And we'd love to put some of that cash to work, earning 3.5%, 4% in a relatively short-term bond. That's not too bad. I know it's not the rate of inflation, but boy, it's a lot better than earning 0.5, which was available, what the bond market was offering for a lot of time after the COVID pandemic. We're also increasing our hurdle rate. And what I mean by that is there's lots of cheap stocks. We looked at the valuation multiple earlier. There's lots of fantastic companies, the kind of companies we'd love to hold for years. But we don't think that given some of the risks out there that we can just sort of blindly say, oh, there's a good valued company. We have a whole list of them. We could fill a portfolio with 30 of them pretty quickly if we wanted to. Again, the hurdle rate really is, we don't know where the bottom is. We don't know how markets are going to react. And we can't definitively say that inflation's been crushed. We think it has been, and we've actually felt that way since March, that inflation is closer to peaking rather than running away. And based on the data, we think we're right so far, but again, we don't want to take it for granted. So our focus is on companies that are consistent cash generators. These are companies that own really powerful consumer brands. A consumer brand, those companies can raise their prices and consumers will still buy them. Typically, they also lead their market share. They're the leading company in their industry. And as a result, they can maintain their profit margins and pay their shareholders, which is us, right? All of us. So we're looking for these kind of companies. We've identified a list of them. We have more companies than we could fill a portfolio with reasonably. But again, we're just being extra careful and judicious on what we want to pay for that. So summary, I think where we are in the economy, I think policymakers are making up for lost time. They were slow to respond to inflation. I think the financial markets and why this year has been so rough for markets is they're worried about how far will they have to go to get inflation under control. Now, based on the data we looked at, we think maybe it's not that far, that we're getting there. And the inflation is going to be under control sooner rather than later. We don't think inflation is going to be like it was, where it was 2%, or 2.5%. I think it'll probably, if we're lucky, be in that 3 to 4% zone for a long time to come. But that's not bad. It's not bad. A lot better than 8%, and the world will adjust and we'll move on. There's some good news on commodities and labor pressures. And as we say, most importantly, stocks are not that expensive, barring a deep recession. If we get a deep recession, corporate profits will come down, usually by 15 to 25%, and stocks will be expensive. And this is the reason why we're not just blindly going out and buying those great companies that seem to be at very good valuation, because we don't know what's going to come yet. What we can say is that based on the weight of the evidence as we're seeing it today, the recession worries are there, but we don't think that it's a fait accompli that the recession is coming. And that sort of recaps what we're looking at, and we're happy to take questions and spend some time answering your questions as well. Okay, let's take a look. Sure. Okay, question is, how are we factoring the ongoing pandemic with repeated and faster new waves into our strategy? I must say that was an area that certainly we could have addressed it due to time. We didn't include it. We are worried that that's an unknown, that a risk that could upset all kinds of things, and certainly. To my way of looking at it, I think it's policymakers' worst nightmare would be that if we get another wave of the pandemic. For now, though, we're trusting that the markets are pretty content with what they're seeing on the pandemic front. But it is definitely a worry in the back of our minds about, hey, the best laid intentions and the best laid market signals and all of that stuff can be laid to waste by the pandemic, and I don't think we're past the pandemic, obviously, and we don't want to take it for granted, but it does worry us. But we think that markets right now are not that concerned right now, and markets have a pretty good record of handicapping these kind of risks for the most part. Okay, so again, thank you everybody for spending the time with us this afternoon. It's a trying time for sure. Lots of scary headlines. I hope that we were able to show you what we see through our daily work and share some of that with you. Again, there is some good news out there on the inflation front, but the risks are there, and again, we're taking it day by day. But I just wanted to do an inventory of the items that we're seeing out there. Thank you so much, everybody. Oh, we got another question. Based on what we know today of the 3 scenarios we're monitoring, which are recession in Q2, a recession in 2023, and the other one was a soft landing, which is the most likely scenario. So one of the aspects is that on the recession issue, the Royal Bank came out today and said for Canada, they expect next year a short and mild recession. At this point, if we got a recession, I think the mild is definitely the case. When it comes, in all honesty, not to be alarmist, again, the data is slow to come out. We may end up finding out that, hey, Q2 of 2022, the recession already began, and that's the kind of the dirty trick that recessions play on the markets, is that recessions are already underway before the economists even declare one is on the horizon. So that's even during the financial crisis, as bad as that was, most of the economists had a pretty benign outlook for the economy. And yet the economy was already in recession, as hindsight proved. So what we're looking at is, as far as the recession goes, as far as the stock markets are concerned, they're not seemingly too worried yet about the recession. They're certainly, so from that side of it, I think that 2023 is a possibility if we are going to have a recession. As I say, to pull off a soft landing when inflation is at 8%, and that's a pretty tall order to do. That being said, we are seeing inflation moderate, and if that continues, we may see that we were able to skirt that recession. So it really comes down to put a final point on the question or an answer, is that it depends on inflation, and if it continues to come down as it is coming down, we may avoid a recession. If we're not in one already. And I hope that helps. The third question, are we not concerned about consumer debt? Certainly in Canada, we are. Canadian households are indebted enormously, and they've only increased that due to real estate costs and things like that. So definitely the case. Sometimes one of the most unique questions I ever got once was at a presentation. Somebody said, "What keeps you up at night?" And I always ask myself that question: What's a few things that, should keep us up at night. And certainly debt is the one, when it comes to the US government's debt, to some degree Canada's, but especially Canadian households, really are indebted huge. And it's a problem, and why I think, like from our perspective, we're not very optimistic on the Canadian economy in any way, shape, or form anyway. Certainly some sectors are good to invest in, but Canada as a whole, and even the OECD has said that over the next 15 years, Canada will lag even Italy for economic growth. I mean, and a big part of that was consumer debt. So we don't think consumer debt in Canada really is an issue for the stock market. Stock market looks at that as a side issue, probably. US households would concern us, but US households are in pretty good shape right now as a whole. Certainly in the bottom 20% of the income scale, it's a different situation, unfortunately. But for the most part, US households are in really, really good shape compared to Canadian households. So, I don't, for Canada itself, it's a bad thing. But as far as broader equity markets and things like that, the Canadian situation doesn't concern us too much as it stands. I think that was the last question. Amin, do you want to? All right. Well, again, everybody, thank you so much for taking the time. I really hope this was helpful. We're always here for any questions or follow-up items that you might have that you see out there, or something that we addressed, or you'd like us to address that we may have missed in this webinar. But again, thank you so much for your time this afternoon.